Netflix betting big on live sports, making its NFL debut on Christmas Day, streaming 2 live games, and of course, one of those games featured a halftime show featuring Beyonce. Joining us now, we've got Santosh Rao, big Beyonce fan, and Manhattan Venture Partners head of research. Thanks so much for taking the time here with us. No doubt you tuned in just to see what was going on, what Netflix was bringing to the table here to the field, and their 2025 programming slate. It's set to provide a strong tailwind for the company, at least it seems, by how investors are looking through. What's your assessment?
Absolutely. I think this was a home run as far as they're concerned. There's a big slate coming up next year. But before that, I think this was a great home run for the ad business that they have. I think it's really going to bolster their ad tier. And overall, I think it's going to pull in. It's all about scale. It's all about monetization. And I think this one was a hit in every which way. There was no buffering issue and all that stuff. So it went out clean and good response from what I hear, what I read. So I think net, I think this was a good thing, good initiative, good foray into real life sports. So I think this is good. I like it. I have nothing but good praise, and it should provide good tailwind going into 2025 after a strong 2024. So I think this is great in terms of everything, all things considered.
Santosh, I want to stay on Netflix. I'm doing a little work on the company. If you go to Yahoo Finance, click on the analysis tab, you can see that the average price target on Netflix is $838 a share. That's about 10% lower than it is today. And that is despite the company crushing earnings estimates every single quarter this year, stock up 92%. Can you still make a case? I hear what you're saying on the company's outlook, but that the stock is still undervalued. If they nail live sports, they nail Squid Games, they nail WWE in January, and this is a company potentially churning out billions of dollars on free cash flow, do you think the stock is still undervalued?
I think so. It absolutely is, because there's still a long runway ahead. They're just getting into live sports, and there's so many other live sports they can get into. Let's say cricket in India, then you got soccer and so many other areas that they still need to. So they're going to pull people into their ecosystem. So the sub growth is going to be strong. The revenue is already strong. The financials are pretty healthy. Yes, there's going to be some pullback, push. I mean, back and forth. But net, a secular trend is up and to the right. Just given all the fundamentals and also the competitive landscape is also not that strong. I mean, they are well ahead of everyone. The others are still rationalizing costs and cutting costs, and there's slate issues, new releases and all that. So Netflix beats them on every angle. And yes, to a large extent, it's priced in, but there is a lot more to come ahead, because they are the only game in town in terms of excellent streaming services and the broad breadth of offering, the genres and everything. So whatever metric you weigh them on, they're just doing a great job, and they will continue to do it. So I would price it on a long-term basis. I wouldn't take a short-term view. They still have at least, I would say at least 15-20% upside from here.
Santosh, I wonder, because this is not about them just loving sports so much. It's because they love the advertisers that come along with sports. And so what percentage of the amount of ads that typically go to some of the historic cable broadcasters or the larger rights holders of these sports would they need to be able to take away in order for that to be passed through to their financial performance and investors really see the full benefit of the different relationships that they're hoping to get on the marketing, on the advertising side?
I think that number is tough to pin down, at least for me at this point. But overall, I think what this does, it kind of gives them more scale. They need more content to pull people in. They need more stickiness, reduce the churn rate more and more. So I think all this is good. They're not going to take all the advertising dollars. That's a long shot. But at some point, they will get a sizable number to get the incremental revenue coming in from the ad business is going to be very sizable, very good for them. And they will, knowing Netflix, they will scale up very well. They will do a good job. So if they start off low and then they really speed up. So their execution has been excellent, and you're going to see that more and more here as well. So exact number, how much they need to really make a mark, I don't know, but anything incremental is good. Their ad business is doing well, the ad tier is doing well, and more of that is even better.